Holy moly, the end of the year sell-off has been absolutely wild so far. The Fear and Greed Index is now showing extreme fear, and bearishness is at a record high for the year. As the broader market continues to panic sell, I've been getting tons of questions on every episode, as well as on Twitter, on Discord, and on Patreon. I'm really grateful that so many people are reaching out and asking questions instead of straight up panic selling and acting on emotion. That already makes you a much better investor than most, including most fund managers who are currently panic selling to pad their end of the year performance numbers. Seriously, seeking answers is exactly what you should be doing in volatile times like these. So I spent the weekend reading through and organizing all of your questions, and I'll be answering them in this episode. I'll throw in every quick tip I can think of to give you every edge that I feel I have from doing this full time. These kinds of Q&A sessions are usually exclusive to the hundreds of people that support the channel as patrons on Patreon and channel members right here on YouTube. So if you're one of my supporters, thank you so much. Your awesome support makes extra content like this possible, and it means even more to me knowing that your own portfolios are probably hurting right now. Since this one is getting posted publicly, I'll do another member-exclusive Q&A for you later in the month. And for everyone else, as always, I'm not a financial advisor, and nothing I say here is ever financial advice. Your time is valuable, so let's get right into the questions. The first and most basic set of questions that I've been getting is what should we be doing now? The answer is that you should be learning how to read the market. Warren Buffett famously says that you should be fearful when others are greedy, and greedy when others are fearful. But how do you know when others are being greedy or fearful? Well, if you go check CNN's Fear and Greed Index, you'll see that we're in extreme fear territory today. That article explains all of the factors they use to arrive at that number. For example, when people flee to safety, the demand for bonds goes up. As the S&P 500 draws down towards its 125-day moving average, people become more worried that it will crash. There are a lot of other indicators on this list that serve as a great introduction to understanding what the heck is actually going on in the stock market at a high level. At the end of this list, CNN also shows you how the Fear and Greed Index has changed over time. Today, it's very low, indicating extreme fear. Here's my extra tip for you. Sentiment isn't the only thing that moves the market. Change in sentiment also moves it. People switched from extreme greed to extreme fear very quickly this time, which is why we're seeing such a large and sharp sell-off in the riskiest assets, the exact stocks and cryptocurrencies that this channel focuses on. Another place to track this is the AAII Sentiment Survey, which updates weekly and shows the ratio of people with a bullish, neutral, or bearish outlook on the market over the next 6 months. According to their latest survey, bearishness is at a yearly high and bullishness has been steadily trending down all month. I recommend you bookmark both of these websites, which I've linked for you in the description below. When I see the market getting to extreme fear territory, I start preparing to be greedy. I add cash to my brokerage accounts, I catch up on all of my highest conviction stocks, I organize my watch list. All of the same things that I've been saying for the last few weeks. Which brings us right into the next question. How do I decide when to buy a high conviction stock versus putting more money into cash or a cash-like position? So the first thing I look at when I decide to put my money into the market is this Fear and Greed Index. The next thing I check is market volatility, which is one of the components of this Fear and Greed Index. The VIX, ticker symbol VIX, is a forward-looking measure of the volatility of the market, specifically the S&P 500. How can a measure be forward-looking? Well, it looks at options on the S&P 500 with near-term expiration dates. That means it's literally just another gauge of sentiment, but more near-term and only from people with money on the line, the people buying those options. When the VIX is below around 12, the market isn't expected to be too volatile in the near term. When the VIX is between around 12 and 20, normal market volatility is expected. And when the VIX is above 20, people who are buying options think the market is going to be very volatile and prices could change very fast. Here's my extra tip for you. In addition to the VIX, I track something called the Vixen, ticker symbol VXN. This is the exact same thing as the VIX, except it's for the NASDAQ instead of the S&P 500. The Vixen is a better indicator for the stocks that I focus on since the NASDAQ is filled with tech stocks specifically. It's also a lot more volatile, which means I end up being much more conservative in when I decide to buy my highest conviction stocks. Here's exactly how I use these indicators. When people are getting more fearful and volatility is high, I put my money in cash-like positions or straight up leave it in cash. To me, cash-like positions are companies like Google and Facebook and Microsoft. I have literally never ever regretted holding these companies over long periods of time. Not ever. But when volatility is too high, even these stocks can come down, and that's when I stick to cash. I'm literally at around 50% cash right now. When I see volatility coming down and the fear and greed index moving back towards greed, I tend to move more of my money into my high conviction growth stocks. Let me know in the comments below whether this makes sense to you or what I should be clarifying. I'm excited to hear what you think. Alright, let's keep things moving with the next question. With everyone panic selling at once, prices are coming down very fast. Should I buy in all at once or slowly average in? In my personal, non-professional experience, I've never regretted slowly averaging in or out of a position and have almost always regretted buying or selling all at once. For example, I started my $100,000 portfolio project in October of this year, so just 2 months ago. Imagine how silly I would look if I spent all my money at once only to have all my favorite stocks drop by 40% just a few weeks later. Here's another example. A few of my friends just bought ARKK at $99 a share. That's a great price, but now ARKK is $95 a share. Whoops. So instead of trying to catch a falling knife, I do exactly what I've said before. I get my cash ready, and I keep my watch list and portfolio organized. For each high conviction stock, I catch up on the latest earnings report at a bare minimum, but usually I listen to the whole most recent earnings call and see what ARK Invest and my favorite YouTubers are saying about the stocks that I care about, because they often catch something that I could have missed myself. Then, and only then, do I look at the price charts for the stock specifically and decide if I want to buy and at what price. And that brings me to the next question. Since many of the companies I look at are unprofitable, what metrics do I use to value a company? Long story short, the two metrics I care about most are the EV to EBITDA ratio, which I'll probably do an entire video on at some point, as well as the price to sales ratio, which I use instead of price to earnings, since many of the companies I invest in don't have positive earnings. Yet. I hope. Here's a good rule of thumb for the price to sales ratio of software-like companies. Take the forecasted 3-year compound annual growth rate of a company's revenue and cut it in half. That's the price to sales multiple you'd probably be happy to pay. Again, this only applies to software-like growth companies like the ones that my channel focuses on and the ones that ARK Invest tends to buy, so don't go using this everywhere. If that just sounded like a bunch of mumbo-jumbo to you, no problem. Let's work through it, using Stone as an example, since they literally just give us this number in their most recent quarterly earnings report. The current 3-year compound annual growth rate of Stone's total revenue is 53%. Wow, pretty high. Let's say I expect that number to be 40% over the next 3 years, even as they launch new products and services and pieces of software and acquire more customers across more verticals. 40 divided by 2 is 20. That's the price to sales ratio that I'm happy to pay on Stone's shares. Stone is currently trading at a price to sales ratio of 11, far less than 20. It's trading at a lower price to sales ratio right now than Microsoft, which is one of my cash-like positions. When I made my first episode on Stone stock, it was trading at a price to sales ratio of, you guessed it, right around 25, which is half of their 3-year compound annual growth rate for their revenue. That's what it means to be a data-driven investing channel. I honestly don't work too hard to find crazy stocks from every market sector like I used to. Instead, I've built one system of indicators and metrics that works for one pretty small set of stocks, and I stick to that set, which are mostly the software-oriented, high-tech growth stocks that ARK Invest researches. And that leads us right into the next question. What stocks am I watching the most right now? I recently made an episode called The Top 9 High Growth Stocks to Buy for 2022, which is my answer to this exact question. I'll leave it in the top right-hand corner of your screen right now, and in the description below as well, along with all the other indicators and resources that I'm talking about in this episode. The follow-up question that I got the most to that episode was, am I still confident in stocks like Tesla, Teladoc, Zoom, Pinterest, Ginkgo Bioworks, Palantir, Mercado Libre, Wejo, and every other company that I didn't mention on the list? The answer to that is yes, definitely, unless I specifically say otherwise. The point of that episode was to give investors different growth stocks at varying levels of risk, from relatively low-risk ETFs with 40 stocks, all the way up to Stone, which is a risky stock in a risky market in a risky part of the world. For example, at the time of this recording, Teladoc is trading at a price-to-sales ratio of just 8, and Mercado Libre is trading at under 9. Those were the next two companies that would have made that list, but I wanted to keep the episode fairly short and sweet. I actually bought some shares of Zoom and Teladoc while making this episode, even though they weren't on that list. So if you want to see the updated list of stocks that I'm watching and get notified when I buy them, consider supporting the channel as an insider tier patron on Patreon or channel member right here on YouTube. Otherwise, I always do my best to keep you up to date with each episode, just like I've been doing, so there's never any pressure either way. The portfolio project is just another way for me to try and add some value to the community. Speaking of my portfolio project, here's the next frequently asked question. Are you still buying ARK Invest's ETFs now that you're doing your own portfolio project? Yep. The reason I don't have ARK Invest funds in my channel's portfolio is because that would defeat the purpose of showing you how I would manage my own positions starting from scratch. I think ARKK, ARKG, and ARKW, which are ARK Invest's 3 biggest funds by far in terms of assets under management, all got hit way too hard relative to the rest of the market because people think the stocks that Cathie would buy are stay-at-home stocks.
We're not going back. And therefore, we think that you should start thinking about these stocks not as stay-at-home stocks, but stay-connected stocks, stay competitive stocks, stay globally competitive stocks, because that's what we do. We're focused on the way the world's going to work and really transformational growth. And for any corporations who are listening to that or other businesses, you need to embrace these new technologies because they're going to be transformational. And if you don't embrace them, you're not going to win. In fact, you may not be around.
In reality, she's found some of the most fundamentally misunderstood stocks on the market, and she's buying them from other people before they realize that they're not stay-at-home stocks at all. When stocks are misunderstood, their prices swing a lot because the market doesn't agree on how to value the underlying company. These price movements are exactly how the stock market transfers money from the impatient to the patient and from swing traders to long-term investors. I gobbled up some ARKK and ARKG recently in my retirement accounts. These are the kinds of funds that I like to buy low and then forget about for years at a time. Speaking of buying the ARK funds low, the next question is, with the possibility of inflation and another wave of the pandemic, do you see ARK Invest's prices going much lower? I've been saying this for a couple weeks now, but I think this really depends on what happens at the December 14th Federal Reserve meeting and what the exact plans are for tapering quantitative easing. It also depends on what's actually going on with the new strain of the pandemic. Is it a big deal? Is it nothing? How will the market digest new information on it? What I will say is that I think volatility will come down over the next few weeks as patient investors and institutions gobble up great stocks at bargain basement prices from impatient investors who are letting them go without really understanding what they're holding. The lower ARKK goes, the more attractive it should become because we know that Cathie Wood has a 420.69 price target on it 5 years from now. Yes, the math actually works out that way based on a recent interview where she said that she expects ARKK to roughly quadruple from its current price, which was $105 per share when she said that. 4 times 105 brings us to 420. Now that ARKK is $95 per share, Cathie Wood should be expecting roughly a 4.5x from here over the next 5 years, or roughly a 35% compound annual growth rate.
Today, assuming that our valuations are crushed down to FANG-like multiples in 5 years, we believe that our strategies, certainly the flagship, all of the innovation platforms together, are going to deliver close to a 40% compound annual rate of return. That's a quintupling over 5 years.
Another question along these lines that I get is about ARKG. Now that tech has gotten much cheaper in general, what do I think about ARKG specifically? So I really like ARKG because I know so little about healthcare in general and anything genomics specifically. The reason I buy ARKG is because the companies inside it have very little in common with the companies I tend to research and pick, which means their prices should move pretty differently in normal market times. This is also the problem with ARKG. When you buy something for a mathematical reason, like spreading out your risk, you don't really build a lot of conviction in it. Then, when more mature and better understood technologies get cheaper, the opportunity cost of holding ARKG looks very high, and now you can't remember why you're holding it. Here's a thought exercise to illustrate what I mean. Imagine the price of ARKG and Tesla both fall by exactly 50% right now. Which one are you going to buy? Here's another version of that same exercise. Every asset you watch just fell 80%. The whole market tanks. What are you buying and what are you selling? That's a good conviction test. The next question is, why are you holding anything that you'd sell instead of buy when the prices are 80% off? That's the problem with ARKG, in my opinion. You want to hold it when you hear about it, but never more than you'd want to hold your highest conviction stocks when they go on sale. That's why I hold ARKG in a retirement account and don't worry about it for years at a time. And speaking of conviction, here's the final question I get asked very often lately. Am I still convinced that the companies that ARK invests in will deliver returns and have long-term success? Yes, now more than ever, as long as we're clear about what long-term means. To me, it means over the next 5 to 10 years, not weeks, not months, years. I'm not here to day trade. I'm here to build a machine that makes my money work for me instead of me having to work for my money. I believe that ARK Invest's ideas about the future are helping me do that.
Most people have never seen exponential growth, and they certainly haven't seen convergence of exponential growth trajectories that we see, for example, in autonomous taxi networks, the convergence of robotics, energy storage, and artificial intelligence. So one S-curve feeding another S-curve. We think that delivers $10 trillion in revenues in year 10 in 2030. Now, if that's right, that's from zero. The returns are going to be phenomenal.
If you tally up all of the content on my channel, something like 85% of it talks about Cathie Wood, ARK Invest, something their analysts have said, or some portion of their research. The more I read and listen to and absorb, the more I'm convinced that they see something in the market that no one else is seeing right now, which is that at least 5 huge technology platforms are coming together to transform our daily lives, regardless of what stock prices are doing this week or next. Tesla is down almost 20% from recent highs. Most of you wouldn't even dream of selling it, and some of you can't wait to buy even more at these prices. But Tesla isn't the only company we should have that same level of conviction in. So what other companies will deliver these changes to our daily lives and the exponential long-term gains that come with it? Well, that's what this channel is trying to find out. So stay long, stay strong, and thanks for watching. Until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.